Hello, everyone. Thank you so much for joining us this morning. I'm very happy to introduce our panel of secondaries market experts on our second annual secondaries market report. My name is Abhilash Jayakumar. I'm the co-founder and managing director of Tres Vista, the leading outsourcing firm supporting financial services firms across the globe in asset classes. Today with me, I have an esteemed panel, starting off to introduce Christoph Brown. Christoph, if you'd like to introduce yourself.
Hi, good morning, everyone. Christoph Brown, Managing Director and Head of the Americas for ICG Strategic Equity. ICG is a specialist asset management platform globally headquartered in London, managing over 60 billion of AUM, and I help run our specialized business in GP-led secondaries out of the US.
Thank you, Christoph. Nigel?
Yeah, Nigel Dawn. I'm a Senior Managing Director at Evercore and Global Head of Private Capital Advisory. We are a leading advisor with over 70 team members, focused on both advising general partners on continuation funds and the like, and limited partners.
Nina?
Hi, everyone. I'm Nina Isaac. I'm one of the founding partners for BlackRock's secondary platform, and we sit within BlackRock Alternatives, which manages just over 300 billion in private markets today. And just from a capital perspective, we closed on our first fund earlier this year and raised about 3 billion. Strategy-wise, we're entirely opportunistic and look at both the GP side of the market as well as the traditional side. And our skew is typically more mid-size, and so we do transactions on average between 100 to 400 million. But happy to be here today and look forward to the discussion.
And last but not least, Jan Robard.
Jan Robard, Managing Partner at Whitehorse Liquidity Partners. We are a firm established in 2015, based out of Toronto. We've grown to 100 people through that period of time, and we've got about 10 billion under management. We've completed about 100 transactions during that period of time, and super excited for this panel.
Thank you very much, everyone. Maybe to kick things off, Vina, I'll start with you, kind of talking about just the secondaries market and the transactions coming out of the pandemic. Now, after witnessing a halt in secondary activity in the first half of 2020, secondaries transactions surged in the first half of 2021 and don't seem likely to settle down. What are the factors that have contributed to this recovery?
Yeah, absolutely. And, volumes have recovered significantly in the first half of 2021. We're roughly at 48 billion. And I think, that compares to what was a slower 2020, given the pandemic, but even compared to 2019, which was actually a record year for the market. And I'd say there's two core drivers. One is the continued momentum that we're seeing on the GP-led side, which represented about 60% of the volume in the first half of this year. And in particular, there's been a step up in single asset continuation fund activity, which has contributed to that. And, I'd say it really reflects just a broader awareness among an increasing number of general partners around the increasing ways that they can actually use secondaries as a way to portfolio manage, portfolio construction, increasing DPI. So given more GPs are aware and there's more reasons to leverage a secondary market, that has contributed to increase supply on the GP side. And then the second key driver, I'd say, is the recovery that we're seeing in the traditional part of the LP market. Traditional LP deals are the bread and butter of secondaries. Historically, they represent about 60 to 70% of volume. We saw a meaningful decline in 2020 as LP sellers just waited out the market for a little bit more stability in terms of NAVs. And so we are seeing recovery in that part of the market as LPs come back. And additionally, buyers who've seen a lot of concentrated deals over the last 9 months are looking for more diversified transactions. I think both of those dynamics have contributed to a recovery on the LP side as well. And our expectation is both the GP and LP side will remain active through year end.
If anyone would like to add to that, I know each of you have a very different perspective that you're coming with.
I mean, I always love to talk. So I would say I totally agree. The interesting thing for me is every time we go through one of these years where there's a lull in the secondary market, whether it's when there's kind of a lot of market turbulence and people are trying to figure out how to absorb that market turbulence and where they're going. That was in 2009, and in 2020, there were dips in the secondary market. And so people say, well, there was a lull, but actually, while there was a lull of activity, there wasn't a lull in discussions. And I think what is interesting in those lull years is that it really enables people to start really kind of thinking about their portfolio and what options are available to them in order for them to get educated. So both those years were education years for people outside the secondary market, in particular, I think in 2020 for the GPs. And in the GPs, as they were thinking about their portfolios and how they might want to reinforce their access to capital and funds, either for defensive or offensive reasons, that whole education push ended up with GPs being a lot smarter about the options and the new tools and the tool set that had evolved over the last 5 years for them to actually actively manage their funds. And there, and then in turn, single assets as an example. That, drove that education is now benefiting in 2021 as people really understood, wait a second, those tools are not just being used in bad times, they can be used in good times as well. And that really kind of is a wave. And so if you think about over the next 10 years, over the next decade, 2010 to 2020 really benefited from that education in 2009. That education in 2009 was probably more LP focused. In 2020 to 2030, what you had was an education of the GP, which is going to create this boom in the GP-led space because people are much more educated and much more willing to lean in.
Yeah. No, speaking of GP-led transactions, Christoph, in our last discussion, last year, you mentioned that single asset continuation funds will be the major driver of volume in the secondaries market. And that statement has played out well as single asset continuation fund transactions have been the major driver of GP-led volume. Besides this, what were the other factors that drove GP-led volume, and what can we expect in terms of the transaction volume as the year progresses?
Thank you, Avi. And unfortunately, I can't move on to another bold prediction of something outside of single asset deals driving growth because it will be, in my view, and I think the general market view, it will be a continuation of the surge in single asset deals. I do want to put in perspective what my comments from last year, just to give you a sense of how explosive this growth has been in single asset deals over in particular the last 2 years. When I made those comments last year, we had done, I went back and looked, we had done 2 single asset deals for about, in total, $600 or $700 million of equity. We, as I alluded to earlier, we specialize only in GP-led secondary deals. So our part of the market is only GP-led deals. And that GP-led market was growing from 25 to over 30 to now 40 billion. So 40 billion of GP-led transactions are the latest estimates across, no matter sort of whatever advisor you ask, in just GP-led transactions. And last year I was talking about I was seeing an increase in the single asset deals, which was fascinating because primarily it was a major innovation in private equity across the board and specifically in secondaries because it was applying, as Jan talked about, the technology of secondaries, which up until then, GP-leds had been a liquidity option as a cleanup trade for a fund at the end of its life, typically 10 years. So all of a sudden, in 2019, the GP community began innovating with using that same technology of a new SPV to buy out some of their prized assets to continue owning their best companies and effectively enabling a whole nother tool of holding some of your prized greatest hits of private equity, if you will, and not only in that 4 to 5 year base case hold, but taking another run at value creation on that asset using this market. So it was a completely new application. So it's like a market expansion, which we think we've now done. Just fast forward this year, we've done 10 of these transactions and committed over $3 billion to those deals. And what is so interesting because single asset deals are very concentrated. The secondaries industry was founded on the principle of diversification. So it's really been an incredible growth to now we think in 2021, single asset deals will likely make up between 15 and 20 billion of that 40 billion plus or minus of GP-led volume. So it's gone from almost non-existent to almost half the market of GP-led in 2 years, which is, and I believe we're just scratching the surface on the most exciting opportunity in private equity and the most undercapitalized, because there's basically every private equity manager with a portfolio and assets that they would potentially like to continue owning can use this. So unfortunately, my new prediction, Avi, is more of the same, if not faster.
And I think maybe to add on to what Christoph has just said, that the next obvious place to go is the sponsor market. So over the last few years, $150 billion of deal flow has just been sponsor to sponsor. One can imagine easily, certainly all the best stuff, and I'm sure most companies that sponsors own are fantastic. But if you take the best assets from the 150 billion, and if you just take half of that, then it's absolutely conceivable within the next few years that the GP part of that market and the single asset part of the secondary market is at least 50%, if not more, of the entire market. If we just look at our business at Evercore, we have advised on just shy of 30 continuation funds this year. So that's 30 this year and $20 billion of GP deals this year. So, and we're just getting into it. So this is just September, the back half of the year. There's a lot of activity. So the activity is phenomenal. The amount of capital available for single company transactions isn't anywhere close to what the current opportunity is. So it's a phenomenal opportunity. And I think, as Christoph said, scratching the surface here.
Those are just staggering numbers. Staggering.
But the funny thing is that it's not. What's limiting the growth of the industry right now is capital and resources.
Yes.
And the reality at the end of the day is, if you ask anybody out there, there is going to be more opportunities than there is capital, and that there are people to be able to execute on it. So it's almost like the opportunity set is growing faster than the industry can keep up with, which is an interesting dynamic in terms of some of the numbers that you're talking about. As that capital flows in, as the resource base comes in, that's another kind of ability to open the floodgates in terms of even further growth.
And just for those that it's not, for those that it's not perfectly clear, because you probably hear about record fundraising in the secondaries market, and so how does that fit with what we're saying about being undercapitalized? I think it's a technical point, but most secondaries funds are constrained by concentration limits in a single underlying company. So while you would have to raise $10-20 billion funds to be able to provide the single asset equity for one of these deals in a continuation vehicle, and so it really is the most underserved market that you can imagine, and a lot more needs to be raised because of those concentration limits.
And Nigel, maybe I can be a moderator for a second. So you see the industry as a whole. Generally speaking, what is the average kind of check sizes that buyers can do, and where do they kind of cap out?
Yeah, look, I mean, if it's usually within a secondary fund, and ICG is probably in some ways the outlier, 1 to 3% of the fund size is generally the concentration limit for a single company. So we see the sort of the most groups capping out, and these are the largest funds at $300 to $400 million per company. But that has to be fantastic company, great alignment with the GP. We know it already. If I think about what I think is the average top end check size, it's probably around 200 to 250.
And as you see, and as you see your opportunity set, like, what are the equity checks that are coming to market?
Oh, I mean, it's incredible. We're working on. I think we've worked on 10 deals above $1 billion, and the implication is then you need at least two investors to probably get half of that capital, assuming ICG is not playing. One group who does write larger checks normally, which is certainly a blessing to the market. But I think often a single company deal of over $1 billion is highly syndicated, simply through concentration risk. So And I think that, you know, Christoph was saying it, the capital formation for single company deals is just in early stages. So I see a lot of secondary investors sort of raising side pockets, you know, raising special vehicles for single companies, you know, and I think we're just positioning ourselves for what's to come. You know, we're not really there yet.
Now, Christoph, you mentioned how the rationale and motivation for GP-led shifting from cleaning up, you know, a 10-year-old fund to creating new value. Is this a shift, or is it additional demand for secondaries that's being created? So the same amount of demand or more for that cleanup is still there, and then you're talking about a whole new product market as well.
I think that's exactly right. The latter. I think, as Nigel said, I think you're seeing consistent growth in what I would call the more typical end of life recapitalization, portfolio liquidity solution transactions that we've all been used to really since 2013, 14, when that market really came of age. This is just in addition, because as Nigel said, this is now a portion of sponsor to sponsor M&A is being substituted by a sponsor, the incumbent GP, deciding it wants to continue to hold one of its own assets and not sell it potentially to another sponsor. And it just, as I said, it extends the whole period. But what it means is that these deals are being applied to not only a single company, but companies that are younger in the fund. So it could be anytime a GP has held an asset for more than its typical base case of 3 to 5 years. We're seeing that, you know, in major volume of younger companies that have been in a fund for 4 or 5 years, and so it's just a major market expansion because of this innovation. And when it's GP led, you know, as the name suggests, the GP is partly the innovator in trying to figure out, I think Yan used the right term, portfolio management and tools in how they manage the assets that they think, you know, the point is that it's the business cycle for the underlying company, and that investment is never going to perfectly correspond with some artificial hold period or the life of a closed-end fund. And so this is just pure gravy to the market, and I think that's why you're seeing the volumes of growth. And we're all being constrained by capital and concentration limits. So it's a fantastic and exciting part of the market to be investing in right now, when a lot of asset classes are you know, pretty fully valued. This still is a really exciting opportunity.
And the last thing I would say is, well, last thing, I don't know. That's a bold statement. That's probably not going to be true. So the one thing I would say is that GPs listen, because I really think that what's happening here is a whole new evolution in the private equity market. And if I kind of look back to the last 20 years, from 2000 to 2010, you know, you had this big push into operational value add. Before 2000, you basically bought companies well, you held them, you didn't do much with it, and then you sold it at the end and you made your returns. By 2010, if you hadn't added operational value add, you know, from 2010 to 2020, you weren't raising $1. Like if you went to your LPs and say, I buy right and then I just sell right and I do nothing with the operational value add, you were dead in the water. And so if you think about what's happening now, what the secondary market is providing you is new tools in your tool set to be able to actively manage your funds so that you can generate good net returns for your investors. And I think that if you don't get on this train, and let's call it the change train, if you get in front of the change train, it's going to hurt. You can jump on the change train and you can kind of ride with it. But the reality is by 2030, if you haven't kind of really absorbed and been able to kind of capture these new tools in the tool set, you'll have been left behind. So my advice to GPs is get educated on this space as quickly as possible and be able to kind of really kind of help yourself manage your portfolios well with these additional tools.
You know, maybe if we shift gears from the GP perspective to the LP perspective, and you know, what can we expect when we talk about LP-led transactions as the year progresses?
Vina, did you want to jump in?
Yeah, no, absolutely. I mean, you know, on the LP side, we have alluded to it earlier. We are starting to see a recovery on the LP side. It was in 2020, there was a meaningful decline in volume, and it's not different from what happened in 2009, where sellers are just concerned around the bid-ask spread, and unless they're forced to sell, in most cases are not, they prefer to wait until there's more stability and clarity around net asset values, and we saw the same thing last year. So we are starting to see recovery in that part of the market, and both because there's pent-up demand from selling LPs, but also because we talked a lot about the single asset part of the market, but there continues to be significant demand for diversified LP transactions as well. So there's buyer demand as well that supports that dynamic. And, big picture, right? You look at growth in PE AUM, private market AUM, private markets, I think, is around 11 trillion. The secondary market, across both GP and LP at under 100 million is really tiny relative to where it needs to be to genuinely provide the liquidity that you need. And on the LP side, secondaries is really the core way through which they can actively manage their portfolios, similar to how you might manage a public market portfolio. And so even if you assume what's historically converted in the LP market is about 2%. So even if you assume that percentage continues, just given the increase in AUM, that in itself drives significant amount of volume on the LP side. So the LP side will, my view will be a very core part of the market. It allows limited partners a much more active way to manage their portfolios, which they do want to do, as we're seeing. And it is probably more prone to blips. I think the GP-led side is as we saw last year, kind of continued to be active starting August last year. The LP side is a little bit more subject to, I would say, lumpiness. And with LPs waiting because they're not looking to sell at massive discounts. You don't have as many distressed LPs at this point. But that said, like the long-term trends and tailwinds are quite strong, I'd say, on the LP side as well.
So both of those discussions are music to my ears. So one of the bold predictions that I've made recently is that the secondary market is going to be $1 trillion by 2030. And the reality, annual volume, $1 trillion. And the reaction I get when I make that statement is one of awe and a little bit of surprise, and there's no way. But if you break it down, there's really two things that has to happen. Private capital, as Vina mentioned, has actually grown from 5 trillion to 10 trillion from 2015 to 2020. 15 to 20% growth rate, doubled in 5 years. What you have to see is private capital move. If you lower that growth rate down to 10%, it's going to get to 15 trillion by 2025 and actually closer to 25 trillion by 2030, right? And so that's the growth rate. Public markets are shrinking, private equity is growing. So that's one. You have to believe that the growth rate is going to almost cut in half in private capital in order for us to get to 25 trillion. Then to Vina's point, what needs to happen is that only 4% of that 25 trillion has to trade for you to get to $1 trillion in the secondary market. That's still a very low numbers. Historically, we've been at 1% of the private capital market trading in any year. To get us to 100 billion, as an example, this year would mean 1% of private capital traded this year. What's going to drive that 1 to 4%? We're talking about LPs being much more active in the way they manage their portfolios. As Vina mentioned, it's kind of this whole theory of like you manage your public equity portfolio very easily. Private capital is becoming a lot more sophisticated in the way that they think about their portfolios. If healthcare and IT did this, you might want to tactically reallocate and see some consumer discretionary and travel on the recovery. And so that shift is happening. And so while there's been a big increase in the secondary market, it's going to boom even more the LP secondary market over the next 10 years as people become a lot more active in the way they manage it. Two, all of that discussion that we had about GP-led was music to my ears. I mean, you're talking about Nigel at the end of the day who said that there's 150 billion of sponsor to sponsor. If you capture half of that, that's 75 billion for the secondary market. And by the way, that's not going to create stagnant. It's 150 billion. That's going to grow every year, particularly with GP-leds. Three, I think the market between GP stakes and secondaries is starting to blur. And what's happening is that, to a certain extent, the private equity used to think of themselves as partnerships. Now they're moving to thinking of themselves as asset management companies. And so they're being a lot more sophisticated in how they're managing their balance sheet and how they're managing their company. The funny thing is that private equity was so focused on managing their underlying companies in a sophisticated way, they never really thought about their company. All of a sudden, the next 10 years is going to be all about driving, maximize value in what they're seeing no longer as a private equity partnership, but as an asset management firm. And how do you actually maximize value of your asset management firm? By being a lot more sophisticated in how you manage the balance sheet of that management company. And fourth, all of this capital that's coming into private capital at the end of the day are retail, high net worth, defined contribution over the next 10 years. Because as public markets shrink, those sources of capital need to have access to private capital. The issue with it is that private capital is illiquid. And the reality is that these in particular need more liquidity, even more than institution. So what's going to drive that 1 to 4% is that the new capital that's coming in needs more liquidity options. And so to a certain extent, that's going to be what punches through from 1 to 4%. All of that. And I will tell you, in 2000, I think at 18 or 19, I made a prediction that the secondary market will be 250 billion by 2025, and nobody believed it. I think that all of the trends are showing that we are actually going to outperform that. And so reality is that $1 trillion by 2030, we're going to go through this waterfall that Nigel always says, well, it starts with like, well, that's not possible. And then it goes to, well, maybe that's possible. And then maybe actually it's possible. Actually, yeah, no, that's going to happen. And it goes to like, well, we knew it all along. So we're going down that waterfall of that $1 trillion prediction. And I actually think we might actually surpass that by 2030.
Well, I certainly hope Yan is right, and I wouldn't bet against the Oracle of Toronto. But I would actually add a fifth driver to Yan's that might put it over the edge, which is wider and growing LP acceptance of the deal. So you talked about obviously LPs managing their portfolio for LP-led deals, but I think the thing we haven't talked about yet with GP-led deals is the amount of exposure that institutional LPs have had to these deals. When we first started in this business in 2014, it was a massive education process. When LPs didn't really understand what was happening, what were these transactions, what was this growing asset class of restructurings and end of fund life deals. And now I think most LPs have a broad portfolio of these transactions that they're dealing with. And I think the liquidity option and the optionality is the key word that is the reason that this market has been able to grow and in such a supercharged way is that it's been done in a way that needs to be LP friendly and provide optionality, no coercion, and the opportunity to get to cash out or to stay in a deal has been a fundamental part of what's allowed LPs to accept these types of transactions.
All this is music to my ears as well. I can't solve the capital problem for you guys, but certainly on the resource side, Trust can be supportive. Earlier, Yan, you mentioned how over the last several years, there's been a lot of GP education that's happening about what is secondaries. And Christophe, you just touched on the idea of LPs becoming more educated and more aware of the secondaries market. Last year, Yan, you mentioned that LPs need to understand the different strategies within secondaries, as not all of them are created equal. And we've talked, earlier in this conversation as well as, the unique innovation that's happening. How have LPs' understanding of secondary strategies changed just over the past year? And how can LPs differentiate between co-investments and single asset continuation funds?
Yeah, let me talk about the differentiation of the industry. It's really interesting because back in the late 90s we called it buyout and everything was under buyout. Today it's not buyout. It's growth, it's venture, growth, mid-market, large mid-market, mega, and you benchmark it in different kind of asset classes to a certain extent. Right now, secondaries, to show where we are in terms of the evolution of secondaries, is that everything's bucketed into one secondaries, right? But actually under secondaries, you've got a whole bunch of different, sub asset classes. You've got the LP secondaries, you've got the levered LP secondaries, you got preferred or structured deals, you've got single assets, you've got multi-asset continuation funds, and to a certain extent, everybody's kind of choosing, what they're leaning into. And what happens is that as an LP, when you're kind of entering and looking to invest in a secondary, you need to start really understanding, what is the risk return of the strategy that's being put in front of you as you benchmark it. And it's not to say that, one strategy is better than the other. It's to say that what's your portfolio need? What are you looking for from a risk return? So I think of it as, if this is like duration and this is, risk at the end of the day, what you've got is even within secondaries, you've got a different kind of line. So if you put, probably structured equity as lower risk, lower return, shorter duration, you've got single asset continuations fund that's higher risk, higher return, longer duration, right? And so you kind of have to start looking at it. It's funny because when people benchmark secondaries from 2000 to, I would say, about 2008, everybody was doing about the same thing. So the range of returns was actually pretty kind of narrow at the end of the day. What you're going to see over the next 10 years is that the range of returns in secondaries is going to widen because different people will have chosen kind of to lean into different strategies. And so that's where LPs might be, if they're not, focused on like, what's the risk return that I'm taking? Why am I taking it? What does my portfolio need? Might be surprised later on to say, well, how come secondaries, like the delta of returns increased so much? This is a reason, right? And again, I'm not saying any strategy is better. I think as an LP, you just need to understand at the end of the day, what's the risk return that your portfolio needs, and then match that with the strategy in secondaries, because there's just different risk returns these days.
Exactly right.
Yeah, and maybe the one thing I'd add is, like, secondaries, historically LPs looked at it as a very efficient way to ramp up the liquids. Like if you don't have a private equity program, secondaries is a great way to, ramp up NAV, preserve your liquidity premium, and also backfill for vintages, et cetera, that you didn't have. And it does feel like there's increasing awareness in the market that it is its own standalone strategy where the return profile is attractive enough so that it's not just purely portfolio construction, but even on an absolute return perspective, and definitely on a risk-adjusted return perspective, it's an asset class that stands on its own, and in many cases ahead of some of other strategies within private markets. And to Jan's point, I know it's been interesting. We have definitely seen LPs who have a preference for the traditional part of the market, just given the excess return potential and the credit-like risk associated with it. And similarly, we've seen other LPs who really love the alpha that they see in the GP-led. So it is very much LP to LP and their organizational construct and approach to risk and construction.
Looking forward, we've talked about how the supply-demand constraint is in place today, but we imagine as there's more interest and there's more players coming to market, that deal quality will become a topic of conversation, and the emergence of lower quality deals in the market. Now, what are your thoughts on the quality of assets in the GP-led transactions we are seeing in the market today, and how do you think that's evolving? Maybe like this. Lead on that.
Yeah, I'm happy to start off. I think generally that what we see, particularly the single assets, is that these are the best assets generally that the GPs ever had. And if you ask GPs, most GPs, what is your number one regret? Beyond not seeing world peace, obviously. And it's that they had to sell their best assets too early. And not only had to sell their best assets too early, but they saw another GP go and make a return, 2 to 3 times, whatever it was that they could have made with their investors. So this technology will say, well, why don't I take my best assets, and instead of selling it to another private equity company or IPOing it, frankly, I can sell it to myself and achieve all the benefits of a full exit without giving up the return. So it's a GP usually picks their best assets to do this. I mean, I think there's Christoph alluded to it, sort of a crown jewel strategy, and what assets with the most upside. So in a sense, I mean, one difference to co-investments on a risk-adjusted basis, single asset secondaries should be much lower risk, but probably with better return. So in terms of quality, we have never seen better quality. I mean, I would say, in terms of lower quality deals, maybe we're not the right advisor to discuss that. But we've never seen better quality, and there's still, we talked about this earlier, too much deal flow, in a sense, too much great deal flow for the for the market.
That's actually I think that's the marker. There's just so much that you as an agent are able to pick, actually, you know what? this is not good quality enough. I've got enough in my pipeline. I don't need to take this to market. And so it's almost like it's self-selected towards kind of very high quality because there's not a capital, not a resources. There's only so much that, you know, even Nigel and can do it in the market with the resources he has. And so you basically, the lower quality stuff never actually even comes to market.
That's right. I think in some ways, I mean, we want the crown jewels of the crown jewel strategy.
Right.
Yeah.
So that's crown jewel squared, right?
Squared, yeah.
Crown jewel squared.
Yeah, I agree with that. I think you have to just separate two things. One is the quality of the companies, so the size, market leading, global platforms, great companies that have been, this is the key point, have been successful investments for the incumbent GP the first time around, and therefore they want to do it again with the same management team, or they have other levers to pull for value creation. And it's now with a series of, you know, top quartile, top decile GPs. So you get higher quality GPs, so the best performing GPs with some of their best assets. So that, I agree with all of that in terms of quality. I don't want to give the impression that every one of these deals is going to be a good deal. And so I do agree with Yan that there will be a higher dispersion of returns and sort of almost stock picking, if you will, of what this looks like 5 years from now, 10 years from now, because I do think what then happens, because I agree with all of that in terms of quality around GP and asset, but I think there are other elements to these deals, such as alignment, the narrative of rationale or motivation to do the deal, and so many different, these are highly complex deals with dynamics around what percent is the GP a buyer of this asset, and are they showing that through rolling over all of the capital they had personally invested and the carry that would have been generated. So there are all sorts of other factors and criteria that we look at in evaluating whether we think that will be a good investment or not, because it's true, the sheer volume of high quality companies and GPs is pretty overwhelming.
Yeah, and maybe the one thing I'd add is the one place we have seen a difference, I would say, over the last couple of months is there's been an increasing diversification of the sectors of companies coming to market. So we just looked at an oil field services company, which I think might not have been launched late last year. So there is increased diversity in terms of the types of GPs now coming to market, and similarly with respect to sector diversification. But would agree from a quality perspective, it has remained high for the points that everyone on the panel has mentioned around it being trophy assets. And additionally, you know, these deals don't typically trade at wide discounts. And in order for existing LPs to agree to the price in order to do a successful transaction, you know, it's likely closer to par. And in order to get that price, the quality needs to be there as well. So it's just
maybe we can talk about pricing a little bit more. You know, Christoph, you mentioned many variables.
Can I add like a few things before we go to pricing? Sorry, I'm sorry. So I think that Vina's point is an important one, and the fact that we talked a lot about the GP side of the equation, but let's talk about also why this is good for LPs. And it goes to what Christoph talked about, which is, you know, it needs to be a win-win-win, right? So right process, right structure, right mindset. And really, if structured appropriately, what you're doing is you're giving the option but not the obligation for liquidity for LPs. And so they have a choice. They have a free option at the end of the day. You know, you can either generate liquidity at the price that's been put on the table, or you can choose to hold. And, you know, free options should be good, net positive for the industry. All you're doing is generating more liquidity in otherwise illiquid asset class and giving people the option for that. And so that's why, you know, this has so much tailwinds, is that because for the most part, not always, but for the most part, the industry is behaving in the way that these transactions are being created. And in order for the tailwinds to continue in this, we have to take care of all three stakeholders. We have to the existing LPs, the GP, and the new buyer, which goes to the second point that I was going to put, which is new entrants, you know, into this market is not that simple, because the reality is you don't just wake up and just say, hey, you know, I can do a single asset continuation fund. A lot of people say, well, I've been buying single assets, you know, in the primary fund, so I can replicate that in this. But the problem is that there's two things. There's the assets, the price that you're willing to pay, and then there's what Christoph talked about, which is the alignment with the GP at the end of the day. And how do you structure that alignment? How do you structure the deal to make the win-win-win? And all of these little nuances are really important at the end of the day, and they're not, as simple as people maybe think that they are. And so you need experience. You need to know how to navigate this to have a successful transaction. And that's what's really kind of causing a little bit of friction in terms of how do you add resources, particularly experienced resources, to help to continue the growth that's available here. Is that it's a bit of a transition, and there's a lot of learnings in all of this. And the last thing I would say is that what's going to be interesting over the next little while, to Christoph's point again, is like when transactions don't go in the right direction. If you've put this into a single asset and the GPs no longer has access to carry in this particular deal, that's when it's going to be a really interesting scenario. Because in other situations, when you're cross-collateralized around a fund, they're still managing that asset because it's going to impact the fund as a whole track record. In this case, it's going to be a single asset in a vehicle where you're going to have lost alignment with the GP, and the GP might just say, been there, done that, move on, and not spend as much time on that asset as they should, because it's kind of the carry incentive is gone. So that's going to be the next interesting chapter as we go through in 3 to 5 years and decipher between the winners and the losers and what actually happens to those losers.
An really interesting point you make about track record. It's going to be interesting to see how the market decides to integrate these deals into track record, and whether there are regulation or obligations to include or not. Be interesting.
So maybe we can jump back into the conversation about pricing. The secondary price has recovered from lows at the end of last year and continue to push higher. As Mina alluded, the discounts are tightening. How did the pricing dynamics work in GP-led deals? Christoph, maybe if you'd like to.
Yeah, listen, I'm happy to take that on. I mean, I think it's pricing is different in GP-led deals from traditional LP secondaries, because traditional LP secondaries was pretty much a 25-year trend of whether there's a wider or discounts to NAV, and very much priced off of that NAV. While we don't abandon that reference point, it's as good a reference point as people have, both LPs and buyers, is that whatever that last quarter or the quarter before NAV was for that asset. GP-led deals, I would say broadly speaking, and Nigel, feel free to jump in, but tend to get done and transact at around NAV plus or minus. So these deals there was sort of an understanding that GP-led deals would get done at around NAV, and then single asset deals have thrown a whole new set of innovation around pricing into these deals because of what Nigel and Yan talked about earlier, that the market for billion-dollar plus deals is so big, and there's so much of those deals that want to get done, but the capital's not there. The right kind of capital is not there to lead those deals for anchoring them for 50% or more of that equity requirement. And so what we've seen is either the classic secondary buyer, as I think Nigel said, 1 or 2 or 3 buyers come together in a club and lead the pricing. But now, in order to get these deals done, not surprisingly, the GPs are innovating, and they're with their careful counsel from their advisors saying, I'll bring in another direct private equity buyer, so another sponsor, to buy a minority stake directly in the target company, and then use that transaction as the pricing anchor and allow the incumbent GP, who is now partnering with another minority buyer, to raise a continuation vehicle around that, their ownership stake that remains. And so that allows the GP to help manage the size of the overall equity needed, and allows pricing to be set. We've even seen on the other end of the spectrum, the same GP using their new fund to anchor the pricing and actually invest in the continuation vehicle. And so there's all sorts of pricing dynamics that are occurring, but it's much more nuanced and complex, and has a lot of different moving parts relative to just typical, whether discount or premium to NAV.
And I think the key thing is, and I think Christoph touched on it, is that the GP is fundamentally conflicted in these transactions. They're on both the sell side and the buy side. They're a fiduciary for the seller. So the GP has to feel comfortable that they can recommend, quote unquote, that price. Typically, one would expect net asset value to be fair value, more or less. So we see, I think Christoph mentioned, that secondary single asset deals tend to get done within 0 to 10% premium of fair value. There is no real case for selling below fair value, and a GP normally couldn't recommend that without some special circumstances, because the GP, like I say, has to recommend it. The GP is not necessarily saying that that is the best possible price in the market, because the GP is initiating the transaction first because they don't want to sell to a third party, not because they do. But what they do want to give is optionality for a limited partner, either to sell if they want to, and that price discovery could be through like a third party GP, an auction that's run by Evercore, for example, for price discovery or some other method. But the beauty here is that the LP is not forced to take liquidity in a transaction if they don't want to. So if they love the asset and want to continue investing with the GP, they have that option too. So it's new technology, it's new optionality for an LP that they did not have before. So, which I see is quite positive.
Shifting gears a little bit, Bina, we've seen record level of fundraising in the first half of this year, driven near term by increasing the near-term available capital to peak levels. And given the demand for capital and the secondary transactions are barely scratching the surface of their potential deal volume, it won't be surprising if we see more new entrants changing the competitive landscape of the secondaries market. And with so much competition potentially coming in, what can a sponsor do to differentiate themselves and stay relevant in the market?
Yeah, it's an interesting question. And maybe big picture, what I'd say is, we've talked a lot about the supply side in secondaries. And I think the view is, just given increasing awareness among LPs and GPs, the tailwinds on the supply side are strong. We'll have blips like 2020, but the long-term tailwinds are strong. But when you actually look to the buy side, it's very concentrated, and about 20 of the largest buyers probably make up the bulk of the fundraising that happens in the market, as well as the capital that gets deployed. And so, I think my view would be that it's actually very positive for the market to have new entrants. It's important for the market to diversify the current buyer base that exists today, and it will allow for increased supply on a go-forward basis. And so, big picture, we think it's a good thing for the market in the long term. In terms of how do these groups differentiate themselves? Secondaries is high velocity, right? It's very data intensive. It's very relationship oriented. And so groups that have faster, more accurate access to information, that have deep relationships with financial institutions, general partners, asset allocators, right, which can then lead to better sourcing and information access. Those are all competitive advantages. So being able to tangibly demonstrate how your platform leads to better sourcing, leads to information access. And the point around information access, I think it is distinct for secondary transactions in particular, in that buyers don't always get a lot of information on a transaction, and it differs depending on if it's a GP-led or a LP transaction, but it tends to be more limited. So the more that a buyer can do using in-house information, using any other information that they have access to, that is going to be an advantage for them. So that's one differentiator that I think groups can use. A second is, and it's been alluded to on this call, focusing on different parts of the market, whether it be GP-led, preferreds, tail-end deals, emerging markets. We do see that certain LPs have a preference for certain parts of the market, and so that could be another differentiator. And a third could be size. There are groups that focus on the smallest end of the markets, the medium part, the large end, and again, LPs have a view on where they see the most alpha, so that could be another differentiator. And maybe the last one I'd note is, going back to the point around secondaries being very data intensive. It's a market where, to the extent buyers can better use technology to organize information better, to get insights better, that will drive their underwriting. For the groups that can do that well, that will be a differentiator in what is a very resource constrained market where supply is growing. And so those are some of the ones I'd note.
Talk about differentiation. One aspect of differentiation is how you differentiate for the LP. The other, how you differentiate to the GP.
Absolutely.
And a traditional private equity firm, often when they meet a management team of a company, are going to try to position themselves as how they can add value and be partners of choice. Now, the full buyout price obviously matters more than everything else. As secondary investors, what are the things that you speak about to the GPs about why you would be a partner of choice? What are the things that resonate?
Yeah, absolutely. I mean, I think that's a very important part of it. Like what we've seen on the GP-led transactions that we've worked together on, and certain hybrid LP transactions, is a lot of times, general partners are looking not for capital, but really for someone who could be a strategic partner to them over time, right? And so, as an example, with BlackRock, we do have a large private equity and private markets program, but we also have public markets. We also have groups that do crossover investing. And so for growth GPs, as an example, the fact that there's so many different touch points within the institution is attractive, because it's not just a partnership with our private equity team, which is great, but they're really buying into a broader partnership with the broader platform. And so that, we found can be a genuine differentiator, particularly for general partners who are, there will be some GPs who are just looking for capital, and that's fine. But for the GPs that are looking for something more long-term, I think that's very helpful.
Yeah, and you mentioned how increasingly GPs are thinking of themselves, or should be thinking of themselves, as asset management businesses, drinking the benefit in portfolio. In this world, do you guys find yourselves often adding operational expertise or value to how a GP should be running its asset management business?
I actually think it's really interesting, because I mean, this is a relationship business at the end of the day, right? And the price obviously has a big component into these transactions, but also what type of relationship you can build with them. And I think that from our perspective, there is so much innovation. I'm fascinated by the secondary market. I've always I always thought back in the day, like there was so many innovations that was happening. It always kept people on their toe. I love kind of new things. I love new opportunities, new challenges. But what you're seeing in the secondary market is that it has become the Google of private equity. It is disrupting the market with new tools in the tool sets. And to be honest with you, we live and breathe this stuff. And I can tell you, I have never seen so much innovation and evolution in such a condensed period of time right now, that even for the secondary players that live and breathe this stuff, there's a lot going on, and you got to stay on top of that. So imagine you're not in this market. Imagine that you are, seeing it from the outside and saying, like, what's going on in there, right? And so to a certain extent, if you can kind of have that discussion and that relationship with the GPs and build trust over time, and be kind of, as Vina says, a strategic advisor of like, hey, these are all the new tools in the tool set. And as long as you bring to the table really an unbiased conversation of like, look, I'm not trying to sell you stuff. I'm just saying, like, there will be times in your life where you're going to have different needs and different requirements. And just so you know, this is everything that can happen, whether it's with your LPs, whether it's under your fund, whether it's at the management company. Here, let's just have a discussion of everything that's available. And I think people really appreciate that. And then over time, what you're doing is you're endearing, you're building a relationship of trust. And so they can come to you at the end of the day when they have a question of like, well, I'm thinking about all these different things. Now, to Nigel's point, if you're going to do a single asset deal, like, you're going to need to bring in an agent. The reality is that you need to price validate this. You need to have the right process, the right structure, the right mindset. It's really hard to do without an advisor. And I would say, to most GPs, like, don't try. Like, this is like way beyond your area of expertise, and these are very difficult negotiations. And so at the end of the day, what's going to happen is that I think that this is just going to kind of continue to grow, continue to innovate, and you can actually enable GPs to better kind of give them that education. That over time it's a relationship game, right? It's about, like, as Nigel mentioned, if you're going to do $1 billion, single asset, you're going to need to bring different parties to the table. If you've built that relationship with a GP over time, they're going to want you to be involved, right? There's going to be enough to go around to a certain extent, and they'll just make sure that they So that's kind of, I think, how you want to approach it. Like, you know, I think that in my world, in the 15 years that I've done this, I go with the motto of when you give, you get. When you do good things happen. And so if you can be good to your partners, and if you can think about them in an unbiased way and give them the things that are not just self-serving for you, but just kind of give them the bigger picture, I think that pays off in the long term. Karma is real.
You know, Veena, you mentioned the data intensity of this industry, and last year, Jan and Christoph, we discussed how data analytics helps GPs stay ahead of the curve. How has the use of data analytical tools evolved in the last few quarters, especially early in the pandemic, where people maybe had a little bit more time to invest in the infrastructure of their businesses?
Is this a plug for your business, buddy?
No.
I was just about to say, we leave the data analytics to the experts and let Tre Vista, you know, the machine, do its work. No, I think I think it's maybe more relevant, a lot of data analytics, looking at some of the LP deals, as Veena mentioned earlier. It's such an advantage to be able to have all of that data on hundreds of companies and, you know, 10s and 20s of GPs and pricing and valuation. I think on the GP-led deals and in its most concentrated form, the single asset deals, it's more about doing direct private equity asset underwriting at the company level. And so it's less about high level data analytics for the types of deals that we look at. And as you know, because we work with you guys on everything we do, Avi, we're getting into the operating models of the companies and the forecasts and running sensitivity analysis. So it's much more micro at the company level for that, and even more so now that it's concentrated.
Yeah, I mean, look, data is everything. Data is power. Information's power. The more you have of it, the smarter decisions you can make. I think for us, like anybody that's involved in the LP side of the market, I mean, I think proactive pricing now has become a mainstay. And then it's about how do you utilize that proactive pricing. So think about data. Think about if you are, basically proactively pricing 100 funds a quarter, as an example, you can end up having dashboards which basically say, look, in this fund, EBITDA is flat, valuation is going up. That's a signal to be like, you should kind of watch it. And maybe, in a world where, there's going to be more actively managing portfolios, secondaries, you've seen it, not just buyers, at times sellers as well. And so then you can kind of look at it as well. If like EBITDA is going up and valuation is flat over a quarter, then that's a buy signal. And so you can almost start seeing a world where, through machine learning, and we've started using that in terms of just kind of, PDFing some quarterlies to be able to extract information, to be able to actually utilize that information for us to be able to have a dashboard that says you should watch, these are your buy funds, these are your hold funds, these are your, sell funds to a certain extent, and you're going to have a dashboard through that over time. That's pretty sounds like a simple thing to do, but it's actually, I think light years ahead of where the industry is today in terms of being able to leverage that information. And then what that does is that in a world where there's just so much supply, you can cull your funnel very quickly. And so you can use your resources very effectively. And as portfolios come to market, you can say like, look, this is a series of funds that we like. And so we're going to lean in, we're going to spend some time on this. And then, this portfolios come in and we're like, actually, we're a little less interested. Not even because we don't like the manager, but in that quarter, our view is that, they may have marked up a company that's, above what we, feel comfortable with at the end of the day. So to a certain extent, there's a lot of this, which is really kind of helping to cull portfolios, to use your resources more effectively, and to action things that you have conviction in and lean in.
Wonderful. Well, we're running short on time here, and I know we can go all day, but last thing, I'll ask each of you just to give your crystal ball prediction of the next year in this market. And I'll call you out on it next year when we have this conversation again.
Next year is in 2022?
Yes.
Yeah.
12 months forward.
Well, we have to say, like, is it volumes in 21 or is it volumes in 22? Or is it just more than volumes?
Whatever you think is the most insightful takeaway that people should think about for the next 12 months. No pressure.
I'm not going to start.
Sorry, Abby, did you call on me? I'm happy to, if that's what you did.
I called him Nigel, but he's conspicuously silent. So why don't you go, Veena?
Oh.
Yeah, absolutely. So listen, I don't know if it's the next 12 months, but one One thing that I think will happen in the market is, to date, the new entrants have been largely on the private equity side or PEGP side. I think there will be non-traditional entrants who might take a completely different approach to how the secondary market operates, particularly on the LP side, and taking much more of a systematic approach versus manual.
Maybe I'll kick it out because I didn't hear the question. My prediction for 22 will be single asset deals constitute more than 50% of the market.
Christoph, he stole your thunder.
Yeah, no, he didn't. He supported the Thunder, which I think is great. I agree with that prediction.
What percent of that 50% will be ICG?
Well, just doing that. I mean, it just comes down to getting big enough. And look, I think you're going to see. I think you're going to see the first, $3 billion single asset deal in 2022.
Okay, so one of the reasons I want to go last was I want to bring all of this together, and I say my prediction for 2022 is that it's over $150 billion. So I think we're running to over 100 billion, which is a huge milestone for the secondary market this year. And I think that just given that momentum with GP-leds, LP portfolios that are coming to market and all that sort of stuff, I think that by 22 we're starting to see real ramp in terms of the volume of the secondary market. We hit over 100 this year and 150 billion next year. So depending on when we do this webinar next year, we'll have a guesstimate as to whether that's feasible or not.
Wonderful. Well, I want to thank all of you for taking the time to speak today, and congratulate all of you on this market. You all are all pioneers and have built what this market is and will be. So our audience very much appreciates your insights. So thank you again, Christoph, Ina, Jan, and Nigel, and everyone for attending today. Take care and stay safe.